Securities and advisory services offered through Royal Alliance Associates, Inc., member FINRA SIPC, and a registered investment advisor. Insurance offered through the Monteverde Group, LLC, not affiliated with Royal Alliance. The views expressed are not necessarily the opinion of WWVA Radio or iHeartMedia and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Now here's your host, Steve Major.
Good morning, everyone, and welcome to Dollars and Cents. And as usual, I'm joined by Jason Haswell, who is the managing director of the Monteverde Group. Good morning, Jason.
Good morning, Steve.
How you doing?
Very good today, thank you.
Well, let me give you a phone number, folks, because a little later in the program, we'll take your phone calls. You might want to write it down and have it handy and ready. 1-800-624-1170. That's 1-800-624-1170. The questions you perhaps will want to address. Our topic today is varying investment choices for your portfolio. Obviously, there have to be different types of investments for the portfolio. What are some of them, Jason?
Steve, there are so many these days. It's difficult. I think, our job has become difficult managing what's out there, and it's certainly become much more difficult for the, our clients and the people out there in the investing public, because there are so many different things. It's changed a lot from many years ago where it was a stock, a bond, a mutual fund maybe, and that was pretty much it. And today there are so many different things. If you look at, most people still own individual stocks, and that's popular, especially in the Valley. You have a lot of stocks people have owned for years, and then been in the family and things like that. But now you've seen things, mutual funds naturally have become very popular over the last, 25, 30 years. But the things that have really become, I think, in the last probably 10 years, you see a lot more of are you see annuities, and you see ETFs, exchange traded funds. And a lot of people just don't quite get what some of these things are, because they offer some things that have not been around before. They're just like technology, things over the years get better, and there are different ways to manage things. And now we have some options that are great for clients, to be completely honest with you.
See, this is where, to me, the trust factor comes in. Mm-hmm. They've got to trust you to help them make the right decision because there's so much to choose from.
Exactly. And what, last week we talked about allocating your portfolio properly based on your risk and your objective, right, and things like that. These are the pieces of the puzzle that help us to allocate your portfolio properly, put you in the right things, the balance between stocks and fixed income and alternative investments. And there are a number of different things, but, we do a research process where we run certain things through some of the software that we have, and we look at, how they're rated, what are their expense levels, how have they performed, what are their holdings, things like that. And we put them through a pretty extensive process of what we use and why we use it, and try to get the best that's out there based on track records and things like that.
Yeah, because I would think that a lot of people coming into you at times will sit down and say, Jason, I don't have a clue.
I think we've talked about that on some other shows. That question is more prevalent than anything else. We get people that come in and just say, what is an ETF? How does it work?
Right.
What is an annuity? How does it work? Most people know what a mutual fund is, but what are the moving parts of it? And, why is one mutual fund better than another? What's the difference between those mutual funds? What sector are they in? Where do they fit in my portfolio? And where we see a lot of this is, people come in with their 401k statement, and they're in certain funds or whatever, and they're just like, what do each of these funds do? I really don't know. Mm-hmm. I don't have somebody to explain to me. I see what they are, and I can see performance on the sheet that they give me. But really, what does that mean? But what sector are they in? Am I in the right places? And we find that, people bring their statements in, and sometimes they're, way too aggressive based on their goals and risk tolerance, and other times they're way too conservative because they just don't quite understand how that fund works or what the moving parts of it are.
What are some of the differences between everything that you can offer, actually?
Right. And the biggest, an individual stock is pretty, self-explanatory. You're buying a stock in a corporation. You own shares in that stock. They go up, they go down on the market. You see what the market does every day, whether it's the Dow or the S&P or the NASDAQ or the Russell 2000,
right.
All those different. You own stock in maybe a local company, maybe like a Westbanco or, a United Bank or something like that. You own those shares and they go up in value. You buy them at 10, they go to 20, you make some money. They pay you a dividend, on a quarterly basis typically. Mm-hmm. So individual stocks are pretty easy. Individual bonds, same way. You're buying a bond, whether it be a government bond issued by the United States, a treasury note, a treasury bill, a treasury bond. Based on the maturity, they pay you a certain rate of interest. They mature on a certain date. Pretty simple. Where you start getting into a little more complexities are things like a mutual fund. And mutual funds have become pretty much, almost everybody that invests in this country now probably owns at least one mutual fund, and because of their 401k plan and things like that. And the mutual fund is simply a group of stocks in a certain sector that is run by either a group of individuals or one individual. They manage that fund for certain goals. You may have a large cap mutual fund, which has only big, well-known stocks in it. But it will hold, typically, you're going to see a fund hold 200, 300, 400 shares of different stocks in that based on whatever their goal. Each fund has its own certain goal. It's a large cap fund. It might be a large cap value fund, which is value stocks are going to be stocks that are a little more conservative, pay a decent dividend, things like that. If you have a pure growth fund, you're going to have stocks that are a little more aggressive, that grow at a faster pace, like maybe more technology based or whatever. But there are large cap value, there are large cap growth, there's mid cap, which are stocks that are a little smaller than, you might have a General Electric, which is a very large stock. But a mid cap stock is a stock that's a little smaller on a market cap. They're just a smaller company. And a small cap stock's even smaller. They are the new companies that are up and coming. And there are funds for each of those. There are funds for foreign stocks. There are funds for each sector of stock. I mean, you can buy a utility fund, or you can buy a fund that has healthcare stocks. You can buy a fund that has nothing but drug stocks. You can buy one that's based in industrial. So there's a fund for everything out there. The thing with mutual funds is it diversifies your portfolio naturally, because instead of buying one stock in that sector, you're buying 300-400. Mm-hmm. So it naturally reduces your risk, and you have typically, like I said, a manager running that fund. You may have a fund company like American Funds or Franklin Templeton or Vanguard or Fidelity. They manage that fund. And there are even funds you just buy the index. Basically, you're buying the Dow Jones or the S&P 500, and whatever the index does, that's what your fund does. So there are varying kinds of different mutual funds. Now, where we've seen a big difference here in the last 10 years is ETFs have come in, exchange-traded funds. And mutual funds trade where you can't buy them like a stock during the market hours. They execute their price. If you buy a fund, it's executed at the end of the day. So you basically put your order in to buy a mutual fund. It executes at the end of the day to buy or sell. So whatever the market does that day, you're kind of at the will of the market. With an exchange-traded fund, it is run by certain companies out there, like you see iShares, you see Wisdom Tree, First Trust, are all big. Vanguard has a lot of ETFs. These funds are not actively, there are some that are actively managed, but most of them are not actively managed. They buy a sector, they buy a certain discipline, they put those stocks in it, and according to either an index or a mathematical strategy, these stocks are put in a portfolio. And it's a varying group, just like a mutual fund. However, they trade just like an individual stock. So you can buy and sell them during market hours. So you can get in and out of them. You could buy one and sell one before the end of the market, where you can't do that with a mutual fund. So, and their expenses are typically less than that of a mutual fund. So they are cheaper to own, and they're a little more liquid and a little more nimble for your portfolio.
All right. Now, who decides what to buy, what not to buy? Is it your client, or is it you, or the two of you sit down and decide what we're going to do with this?
Typically what we do is we sit down with the client, and I think we've mentioned in some previous shows, we do a proposal for them. We talk to them about their budget and the amount to invest and what their risk tolerance is. There's a number of questions we go through to do an initial profile of that client. We then design a proposal for that client based on risk, objective, time frame, things like that. So what we do then is after we have that profile, I go in and typically look at what we feel are the best options to fit the allocation that fits them. So we have a process where we use some software that a lot of people in the investing world will know of. It's called Morningstar. Morningstar rates ETFs, mutual funds, annuities. They do stock research. We run them through a Morningstar filter, and we filter out. Basically, we're looking for the highest performing, lowest expense ETFs and mutual funds out there. What's done best with the least amount of cost over the longest period of time, and what are the moving parts in the holdings, and then we design a proposal for them based on that. The client can tell us, we come back and present, they can say, I'm not comfortable with X, Y, or Z. We can go back to the drawing board and make some adjustments accordingly.
Right.
Sure.
Right. Okay. Before we take a break again, let me give you this phone number, 1-800-624-1170. If you have a question for Jason, give us a call on that number, 1-800-624-1170, and then he will be more than happy to answer any one of your questions concerning your, perhaps, portfolio, how you want to invest. We'll be back right after the break. Stay with us. You're listening this morning to Dollars and Cents.
Trust is beautiful, intangible, and invaluable. In relationships, trust is earned. It is the knowledge that you can completely rely on someone who puts your well-being and best interests first. At the Monteverde Group, we earn our clients' trust by helping them create a plan that can allow them to reach greater financial heights. Wealth management for today, financial independence for tomorrow. Call Jason Haswell at the Monteverde Group, helping clients grow, manage, and preserve wealth.
This report is brought to you by Experian.
News Radio 1170 WWVA. Severe Weather Team 9 forecast.
Fall is off to a hot and dry start this weekend. Sunny skies today with a high near 88. A beautiful warm evening until the sun sets, and then clear skies overnight. We fall to 61. And on Sunday, patchy fog to start your day, but mostly sunny skies, a tad humid with a high near 89. I'm Severe Weather Team 9 meteorologist Stephanie Allison.
Last year, corporate data breaches were up 40%. This year, it could be worse. Find out if your data is at risk with a free dark web email scan only from Experian. In less than a minute, you'll know if your identity is at risk. Go to Experian.com/scan to help keep your identity yours with Experian.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
Refreshing your news feed at the top and bottom of the hour and posting opinions the rest of the time. News Radio 1170 WWVA.
Welcome back, everyone. You're listening to Dollars and Cents. I'm Steve Major, joined, of course, as usual, by Jason Haswell. Beth is on the line. We asked for a caller. She obliged. So, Beth, good morning, and what's your question this morning?
Good morning. I had a question to ask about what was the difference between a mutual fund and an ETF, but Jason had answered that. What individual stocks are more risky? Are individual stocks more riskier than mutual funds or the ETF?
Okay. Thanks for the question, Beth. It's a good question.
Sure.
With individual stocks, yes. I mean, we have some clients naturally that prefer individual stocks, and we use them a lot in a mix of the portfolio. So we'll have typically a design where we have maybe a mutual fund, several ETFs, and a few individual stocks in a portfolio. But the issue with individual stocks, especially for more beginning investors, is, naturally, if you buy a fund, say you're looking at healthcare stocks, if you buy one healthcare stock and that stock goes down, naturally, you're in one stock, and it's if it goes down, you don't have any balance there in that healthcare field. If you buy an ETF or a mutual fund in the healthcare side, then you have a grouping of stocks. So if one goes down, it doesn't affect the portfolio because you may have 50 or 100 different stocks. So it spreads your risk out over several, stocks in the sector. So if one drops, you're okay. And it just takes a little bit more risk out of that. But, some people prefer individual stocks. You can get, a little quicker growth, especially if they do well. But it does add a bigger element of risk to the total portfolio.
Okay. Thanks to Beth for calling in. And basically, she's asking a question that I was going to kind of ask. What are, in essence, the pros and cons of the different investments that people make?
Sure.
Because you can sit down and say, well, this is a good deal. This is not such a good deal.
Yeah. And each one has its own, things that are good. For example, like we've spoken about with the ETFs and the mutual funds, they're more diversified. You got a grouping of stocks. It takes the risk out. But comparing that to an individual stock, the pros there would be lower risk, better diversification. The con would be they're not going to typically perform as well as if you buy one stock and it goes through the roof, your performance is going to be a bit higher. You are taking more risk, assuming more risk. Mm-hmm. But, so there are between those, you have to weigh those options. And a mix is typically, you want to kind of have a little bit of both. Each individual investment that we look at, when you're looking at groupings like the ETFs, the mutual funds, or an annuity or things like that, you have to look at expenses. So, ETFs are you can get ETFs that are very, very inexpensive. There are internal costs for, naturally, the companies have to do trading. They have things, that are add costs, and they pass that cost on to the investor or the client. Mutual funds typically are a bit higher in expense. But there are some out there that are worth paying that expense. And what we weigh is what they do worth their expense level. We try to minimize that as much as we can when we design a portfolio. We look at things like expense level, tax implications, performance, of course. But one thing you have to look at is there may be instances where it costs a bit more to own a certain investment, but you're willing to pay that cost because they have outperformed all their peers, or because it fits your style, risk level, whatever, better. Or you have confidence in maybe that investment company. I mean, there are a lot of people out there, American Funds has been a mutual fund company. It's been around for years, and they love them because of their style and how they've done things. So people will buy that fund because of the reputation of that company. So that's something we weigh with the clients, is naturally performance, but what does it cost you to own the investment? Are they outperforming their peers? And we look at that, like we've talked about a little bit before, on a quarterly basis. We're reviewing this, saying, okay, they're doing great against their peers. Maybe they're not doing so well. Maybe we need to make an adjustment. Mm-hmm. So each one has its own individual, pros and cons in the style of investing, whether it be ETF, mutual fund, individual stock, bond, whatever. All those factors go into how we pick and how you should pick what individual varying investments you have in your portfolio.
Do the investments change, I guess, as much as like the stock market? The stock market could be up today, it could be down tomorrow.
Yes.
The others go through the same varying whatever, so to speak?
Yeah, they do. And the thing is now, the one thing that's become, I've been doing this for 22 years, and the thing that I love about, when ETFs came in is there was a lot of things that the average individual investor could not invest in, like commodities. They couldn't go out. The average guy couldn't go out and buy pork bellies, or heating oil or cocoa or sugar. It was difficult to do that. Right. You had to go out and actually buy the physical commodity. And you could do that, but it took larger sums of money, and there was a lot of moving parts there. Now, through an ETF, you can buy all those things. There's an ETF. If you name it, we can find an ETF for it. All the things I just mentioned, you can do gold, you can do foreign countries. I mean, if you want to buy a Vietnam ETF, you can do it. If you want to buy a Brazilian ETF that has nothing but Brazilian stocks, you can do it. So it gives us the ability to diversify and allocate the portfolio even more specifically and take advantage of opportunities that we may not have been able to take advantage of 10, 15, 20 years ago. So there's a lot out there, but you can find, there's an ETF for pretty much everything, which is amazing for the individual investor.
How often do clients meet with you, or you meet with your clients? Do you have a set schedule, or can they just call and say, hey, I got some questions, I'd like to commit?
We do. We have a set schedule, and they can call. We have a lot of clients that I talk to some clients, on a monthly or weekly basis, depending on their level of, of what they want and what we're doing. But most of our clients we have a set schedule where we meet with them every quarter, every 3 months.
Okay.
And we sit down and we print out a proposal a report for them. And the report shows what they've made for the year to date, or we can look at it any number of ways. We can do trailing 1 year, year to date. We can do 3 year, 5 year. We can do the last month if you want, whatever you want to look at. But typically we look at year to date performance when we do the review. So we show them what they've made. We show them the investments that are there, what each one's done. And then we discuss with them what we think the market's going to do going forward and maybe what tweaks we need to make in order to take advantage of current market opportunities or situations. Maybe we're in one investment that's done very well. We need to peel that back a little bit and move into something that's an opportunity. So we meet with them to do that. Other times on the quarter, we don't need to make adjustments. If it ain't broke, don't fix it. So we don't need to make an adjustment there. We just go through the performance. They see what they've made in percentage, what they've made in dollars, what their total dividends are. We have all that in our reporting. So you're very much up to date as to what's going on with your portfolio. And we're very diligent about getting people in to see us. Some people don't need to see us every 3 months. They just say, hey, great, everything's good, Jason, I'll see you in another 3. Or we have other people that come in every time. But we contact them either through email or phone and get them in for a live. I like to meet with my clients in person, and we do that with most people, I would say with pretty much everyone every 3 months, every quarter.
Okay. Current. You use the word current. Let's use current events.
Yep.
The hurricanes that have struck Florida, the wildfires that have hit out west.
Sure.
The situation with North Korea. How many of these types of things affect someone's investment or portfolio?
That's a great question. And there's a chart, and we're doing radio here, so I can't show it to you, that I have in my office, and it shows going back to the 50s, all of the geopolitical and worldwide events that have happened and what the market's done in accordance with that. And, everybody's always, short term, it's, oh my God, the world's coming to an end. As I like to tell clients, the world only ends once. So, but those events affect the market. But if you're in it with a long-term time horizon and you have a plan, you'll weather that storm. You just got to do it. You got to have a plan in place. You got to do it the right way.
Right.
But they do affect the market, especially on a short-term basis. North Korea, for example, a couple of weeks ago, all the things they're shooting missiles, as our president likes to call him, Rocket Man's firing missiles over Japan, and the market dropped because of those tensions. And because those tensions have kind of wavered, now they're just basically insulting each other, but we're not shooting missiles off. The market came back over the last week and a half, 10 days. So that has effect. The hurricanes, it's with the hurricanes, they affect more, not so much the market, but certain markets, especially the oil market. Because when they hit in port cities, especially when they hit in places like Houston, they're refining a ton of gasoline. The ports shut down, and you can't bring in the oil you need to refine that gasoline. When they're shut down for long periods of time, supplies naturally then drop for gasoline, and prices go up. And we've seen it at the pump. When Harvey and Irma hit, you saw, especially with Harvey, because it hits, that's the biggest refining area in the country. When Harvey hit, gas prices shot right up. So it has a big effect, especially on certain commodities. And the other thing is, when you shut down a major port city, like down in Houston, and you can't bring those goods in, even if it's not just oil, naturally, because they can't get to market as fast and they're sitting there, it brings costs up and supply. It's the old supply and demand thing. If the goods aren't flowing at a regular pace and you cut those goods off, naturally the cost of those goods is going to increase. So it does have more of an effect, I think, not on the larger scale market like the Dow or the S&P, but on the oil market especially, and on the commodities markets individually. It has a huge effect. And the other place it has a big effect is your individual pocketbook. because we're paying a heck of a lot more for gasoline in the last 2-3 weeks than we were before that.
The price of gas has begun to drop just a little bit.
Yes, sir.
Hasn't been dramatic.
No.
And I think you'll see more of that, as you said, as those refineries begin to start up again and be able to go into full operation. But at this time right now, it's still...
Well, they got to get them back in running.
Yeah,
and then once the supply starts flowing back at a normal capacity, you will see those prices begin to drop. Now, the other thing I'll say to that is the prices always go up much faster than they come back down. So I don't think that's an accident. But yes, and you're seeing it now. You're starting to see gasoline come back as they get all the refineries back on. That supply chain gets back up and running. The ports are getting repaired and things. They get up to full capacity. You'll see those prices mitigate and come back.
And the fruit production down in Florida, for instance,
Great.
Devastated because of the hurricanes, and that has an effect on what we go to Kroger's or wherever to buy.
It has a major. What
Sure.
people don't realize is, with oranges, if the orange crop, if you have a massive hurricane and it destroys, 30% of the orange crop, your orange juice prices are going to go up. What you purchase in individual oranges is going to go up. Strawberry production, all those types of things. The fruit production that's down there, sugar cane, different things. It's going to have a major effect on what you're buying and the prices at Kroger when you're buying those certain things.
All right. Okay. If you'd like to talk to Jason or any one of his coworkers, they are located in the Wagner building, which is at... what is that? That is 2001, 201 Main Street, Suite 402 here in Wheeling. Their telephone number is 304-905-0641. Be sure to give them a call. I'm sure they would be more than happy to talk with you. Again, next Saturday at 10 o'clock, another version of Dollars and Cents with Jason Haswell. Hope you have a great week. Jason, go watch the Mountaineers.
Absolutely, Steve. Let's go Mountaineers.
All right. We'll see you again next Saturday. Have a good week, everybody.